The rise and crash of company where it went wrong. Angle WeWork, FTX, Evergrande, Peloton, Yellow Timeline, plus 3 takeaways. Every empire appears unstoppable until it abruptly falls apart. At one point, company was heralded as the next great thing, a company that would transform its industry and alter the way we work, live, or consume. With billions of dollars in finance, visionary promises, and constant media hoopla, company quickly became well known. However, the empire was constructed on fragile foundations, much like WeWork's expensive offices, FTX's fake billions, Evergrande's debt mountain, Peloton's exaggerated development. This breakdown will cover the entire story of how company reached incredible heights and then collapsed spectacularly. It will conclude with 3 important lessons that every investor, consumer, and entrepreneur should keep in mind. Number 6, the birth of the dream. Like all great stories, the beginnings of company were rooted in a dream. The founders had a daring idea when they first entered the market, one that looked both important and exciting. They made the straightforward claim that they were proposing a revolution rather than merely a good or service. Investors were captivated by the founders' charisma and the prospect of unrealized potential, so they quickly fell for this story. Early consumers were equally captivated by glamorous advertising efforts and the promise of becoming a part of something novel and revolutionary. At this point, the press was crucial in spreading the word about disruption and innovation. As though it were destined to become the next Amazon or the Apple of its industry, headlines praised company. People decided to ignore or failed to recognize the foundation's vulnerability. Number 5, the meteoric rise. Following the establishment of the dream, company began its explosive growth. With enormous venture fund inflows and unrelenting ambition, expansion took precedence above all other considerations. The business quickly increased its footprint, frequently surpassing its capacity to continue operations. Sometimes offices, goods, or platforms were introduced worldwide before the local viability of the business plan was established. The founders became legendary figures as a result of media attention visionaries who could do no wrong. Interviews, magazine covers, and conferences portrayed them as influential figures altering the future. The approach was based on the idea of grow now, figure out the rest later, much like WeWork's extravagant spending or Peloton's exaggerated sales forecasts. Due to their fear of losing out on the next trillion-dollar company, investors disregarded the warning flags. Number 4, the red flags. Before long, cracks started to appear. Delivery delays, product recalls, financial inconsistencies, or increasing debt that nobody wanted to discuss were all examples of operational inefficiencies. Consumers began to protest, but management dismissed them, claiming that growth pains were inevitable with rapid scaling. Employees started to see concerning trends within the company: careless spending, a lack of responsibility, and a culture that prioritized hype above real performance. To divert attention from the fundamental problems, marketing spending skyrocketed, collaborations were hurried, and grandiose declarations were made. The business appeared more focused on keeping up appearances than on repairing its core issues. Similar to Evergrande's concealed debt or FTX's murky finances, the warning signs were clear in retrospect, but disregarded by those who stood to lose the most at the time. Number 3, the tipping point. Every downfall has its breaking moment, the exact point where perception flips and reality can no longer be denied. For company, this came in the form of a single event that shattered confidence. Maybe it was a major earnings miss that revealed how deep the losses were. Maybe it was a leaked investigation into fraudulent practices, or perhaps a failed funding round that left the company without cash to survive. Regardless of the trigger, the effect was immediate. Investors panicked, stock prices plummeted, and customers lost trust. What had taken years to build unraveled in weeks, proving that when trust disappears, collapse is inevitable. Number 2, the crash. The crash was swift and merciless. Stock values hit rock bottom, wiping out billions in investor wealth. Customers abandoned the brand, seeking safer, more reliable alternatives. Partnerships dissolved as companies scrambled to distance themselves from the sinking ship. For employees, the crash meant layoffs, pay cuts, and shattered careers. Entire teams who had once believed in the mission were left scrambling, betrayed by leadership decisions far outside their control. A brand once synonymous with progress became a symbol of failure, arrogance, and the dangers of unchecked ambition. Number 1. The aftermath. After the collapse, the story only grew darker. Lawsuits mounted as investors sought to recover their losses. Regulators stepped in, probing allegations of fraud, mismanagement, or even criminal wrongdoing. Former executives who once basked in fame now faced intense scrutiny, with some even testifying before courts or government bodies. Bankruptcy filings revealed just how bad the financial situation had been all along: massive debt, unpaid vendors, and liabilities that far outweighed assets. Employees struggled to rebuild their careers, often carrying the stigma of being associated with a failed empire. The aftermath left scars not just on balance sheets, but on trust, reputation, and entire industries. Takeaway 1. Hype reality. The first lesson is that hype is not the same as success. A compelling story may fuel massive growth, but without a solid foundation, the truth eventually comes out. Investors and customers must learn to separate vision from execution, because in business, reality always catches up with the dream. Takeaway 2. Leadership matters. The second lesson is the role of leadership. Visionaries may attract funding and inspire teams, but unchecked egos and reckless decision-making destroy companies faster than competition ever could. Leaders set the tone for culture, accountability, and discipline. And when they fail, the whole structure collapses. Takeaway 3. Sustainability over speed. The final lesson is that true success is not about how fast you grow, but how strong your foundations are. Sustainable businesses focus on profitability, resilience, and steady progress. Chasing rapid expansion without discipline is like building a skyscraper on sand. It may rise quickly, but it will collapse just as fast. The story of company is not just about one company's failure. It's about human ambition, greed, and the illusions we buy into. It reminds us that no empire is too big to fall, and no hype can protect a weak foundation forever. What do you think? Was this collapse inevitable? Or could it have been saved with smarter leadership? Share your thoughts in the comments, and don't forget to like, share, and subscribe for more deep dives into the rise and fall of business giants.